Hey, here we go. We're going live in 3, 2, 1. Hello, welcome to our live broadcast of Wealth Wednesday. We're going to talk about how the market has done so far year to date. I'm going to put some stuff up here on the screen here momentarily. I'm joined by Daniel Spurgeon, who's a member of our investment committee. We're going to talk about things today like what's happening. The inflation number that came out this morning is just wasn't what anybody wanted to see. We're going to talk about something called rebalancing as well, and that just happened here a little bit ago. So let's first kind of jump into so far what has gone on in the stock market as well as the bond markets so far in 2024. And what we see is that the S&P 500 and the NASDAQ composite, who are still led by those big tech names, the Magnificent Seven, are up very nicely, even with today's little pullback. The NASDAQ's up 9.2. The S&P 500 is up 8.6% year to date. The Dow, which is not quite as focused on those tech names, up 1.8% so far year to date. And bonds just haven't quite responded very well this year, down about minus 2.7%. So, Dan, the Magnificent Seven been the story of stories over the last couple of years. The NVIDIAs, the Microsofts, the Amazons of the world have really driven the stock market higher. Everything else is kind of lagged behind. What are we starting to hear and think about where these are headed and what that might mean for the rest of the market?
Well, as anything, you get some mixed views in our world. Analysts have different opinions, but I would say that the resounding majority is definitely saying that a lot of these major tech names have obviously had a fantastic run up over the last 10 to 12 years, and really since COVID, they've been really, really solid and been the major driver of market performance. So, we've heard comparisons of late 90s, early 2000s, prior to the 01 tech bubble. You're starting to see market caps really compress into, or should I say, really get overweighted and focused into about 10 to 12 stocks, making up 34% of the S&P 500 right now, which a lot of people don't understand that the market is market cap weighted. So there may be 503 stocks in the S&P 500, but again, 33% of the attribution of that is going to be amongst 12 stocks. So all of 8 of those being the Magnificent Seven, Google having 2 share classes. So obviously not knowing the future, but you got to scratch your head and say, how much longer can this last, especially in a higher interest rate environment.
Yeah, and in those 7 companies, the valuation, if you use a traditional PE type ratio valuation, is extremely high compared to the rest of the market. I think it's really pulled things up. So there's probably going to be some consolidation of sorts. Either the rest of the market is going to catch up, or these 7 may pull back a little bit. And I know I read a commentary yesterday where one of the funds that we're using is a kind of a momentum-based strategy, has kind of exited that tech sector to a degree because of the momentum just hasn't been there. So it could be somewhat of a pullback in that regard. Wanted to talk a little bit about bonds in general. And we made some pretty significant changes a year ago in our bond holdings. And really, when the inflation news came out this morning, I think that did not do well for the prospects of interest rates decreasing as we go into 2024, although that's been kind of the anticipation. We did make a change here last week, or 2 weeks ago, where we extended the duration of that to take advantage of those potential decreases. But Daniel, can you touch a little bit about how we've constructed this portfolio of bonds to survive in just about any kind of environment?
Mm-hmm. Yeah, so we've taken 2 approaches within the bond portfolio, 2 strategies. One of which almost half the bond portfolio is what we would consider defined maturity. So a mix of different bond strategies or different bond rating scales, if you will, between corporate, high quality, a few high yields. And what we've done is we were able to really, we timed it very well. And again, not touting that we can consistently time things perfectly, but last year when rates spiked, we were able to get in and really lock in some very, very attractive yields if those bonds are held to maturity across the spectrum. And then simultaneously, we've paired that with some actively managed bond positions that are relatively unconstrained, where those managers that we've done our due diligence on, we feel that they will add a lot of value in a rising or sideways rate environment. And then obviously, if we see a rate decrease, they'll have the ability to pivot and position those portfolios to take advantage of a rate decrease. And then the last leg of that second half is looking at extending duration, to Neil's point, looking at a couple of bond positions that have taken our effective duration from around three years last year up to 5.5 now, with the anticipation of rate cuts. So trying to take part of the portfolio and say, regardless of where interest rates go, we know we've locked in a very attractive yield, and then take part of the portfolio and say, all right, look, let's make a call if rates drop. We're going to be positioned incredibly well. And if rates stay sideways, we have the ability with a few of those unconstrained strategies to still make a nice yield.
Yeah. And if you look at a couple of the funds that we own in there, the 20 to 30 year and the 10 to 20 year treasury side of things, those funds, if you look at them in isolation, will absolutely blow your mind about the wild performance swings that they will have. And duration for the layman would be just how sensitive the portfolio that we have is to a change in interest rate. So if you have a duration of 1, for example, a 1% change in interest rates means that portfolio will change 1% in value. So when we extend that out to 5, as we have, if we see a 1% decrease in interest rates, our expectation would be that we get a 5% bump in value as a result of that. So that's how we've kind of structured those things as we go forward. Next thing I want to talk about a little bit is rebalancing. It's something that a lot of companies do, a lot of managers do. Give us the basics of this, Daniel, what it really means and what we should expect to see throughout the year when we do this.
Sure. So I guess we'll just start 30,000 foot view conceptually with what rebalancing is. Initially, anytime you meet with an advisor, you're normally going to establish some range of risk tolerance or how much volatility as a client you're willing to accept, which along with planning should determine your overall allocation. So for example, let's just use a 60-40, which is touted as the traditional retirement portfolio allocation, 60% stocks, 40% bonds. Over time, if stocks move up, which we anticipate they will over a long period of time, and you do not rebalance the portfolio, that 60% will then slowly become 65, 70, 75% of the portfolio, and it will over time become overweighted in stocks. And i.e. you as the client are now taking more risk and are subject to more volatility than maybe you were previously comfortable with. So what we try to do as a risk management measure is we set tolerance bands depending on the positions in the portfolio. So if a position does grow or loses on the flip side, and the portfolio becomes out of balance, i.e. taking more risk or less risk than the ideal strategy would initially necessitate, then what we're doing is we're going back in and rebalancing that and bringing all those positions back in line with the original allocation to try to keep that risk level in line with what we are telling our clients that they're in. So we don't, in layman's terms, we don't want you to get too overweighted in risky portfolio or risky assets, but we also don't want you to get too underweighted in a down market where you see equities sell off dramatically and a 60-40 is now a 50-50 or a 40-60. We want to make sure you stay in line, so that helps recovery as well.
Right. And the adage is buy low, sell high. And this is essentially, rebalancing is essentially a pre-programmed, predetermined point in time, which we will do that based on the overall percentages. We aren't necessarily going from something where you are a target 60/40, as you use an example, and we're buying, if it's gone to 65, we're just bringing it back to 60 on the stock side. We're not necessarily going, well, we want to go all the way to 50 in this instance. That would be something entirely different. And we don't really intend to do that unless there is a significant reason, either from your standpoint or our overall view of what's going on in the market as a whole. So our intent for most of our clients is to do this quarterly. We do it right around the last Wednesday of each calendar quarter. So you'll see some trading activity that happens during those times. And it may not be much of anything. Other times it may be a bigger move than you would maybe have anticipated. We did, in our last rebalance, add a couple of different funds to the mix. So that's also an opportunity that we have to take advantage of maybe a different opportunity or a different fund that we like. And it's also a way that if you're taking a regular monthly income stream, that we will regenerate cash for your portfolio so that we can send that out to you as a whole. Daniel, one of the things that everybody's always concerned about is the next drop. And after we've seen a nice big run up like we have so far, before today, it was plus 10%, double digits on the two of the major indexes at least. Is there a major cause for concern for a significant correction at some point during this year?
Well, yeah. So, I mean, if you look back historically, the standard deviation or volatility of the market, the S&P 500 is around 18%. So it's not abnormal for us to see 10, 12, even 15% pullbacks at least once a year, if you want to look at it on a calendar year basis. Obviously, the market doesn't move just in calendar year basis, but I think it would not be, with an election coming up, not to make it political, I don't think that's going to be a huge driver. A lot of it's being, predicated by what the Federal Reserve does with interest rates at this point, as that seems to be a lot of the main driver of most market movement. But, if you told me we saw a 10 or 12% pullback in the next 6 months, that would not surprise me. There's enough, again, market movement with interest rate movement. If inflation numbers continue to come in hot, if something does happen screwy politically and the media gets a hold of it and runs with it, there's a lot of things that obviously we just can't account for. And even if nothing crazy happens geopolitically or domestically here, it's still not abnormal for the market to consolidate and pull back 10%. So do I think we'll see a 30% drop? No, but here's to me hoping we don't either. All right. We obviously 2022 wasn't fun for anyone. But no, I mean, the market, the economy has really held up very strongly despite a rising interest rate environment. And I think that speaks to how strong our U.S. economy is compared to China and Europe. But no, I think 30% is probably very unlikely. 10 to 15 wouldn't surprise me on a pullback.
Right. And that's statistically normal. I mean, it's that a 10 to 15% drop is perfectly normal and should be expected. It's probably more rare that it doesn't happen than if it does. A lot of concern about the election. We're not going to dwell on it a whole lot. You kind of touched on it. I don't think it's going to be a big impact either, but it's probably one of the biggest questions that we get. And to me, it's still about profits. If profits are there, I think the market is going to respond positively to that. If the profits aren't there, then I think we'll see the reaction accordingly. Last question for today, and then we'll wrap it up. The higher interest rate environment, do you see that as a good thing for folks in general, or is it a bad thing for us?
Depends on where you're at in the stage of life. So historically, higher rate environment, if you're using, not to get into statistics and net present value of cash flow calculations, but if rates are higher, you have a steeper discount rate, which can often lead to a little bit more of a muted stock market as far as market growth. Would I expect us to continue to see 12 to 15% a year like we got accustomed to from 2008 to 2020? Probably not. I'm not saying stocks won't continue to grow. I think they will. But a higher rate environment would lend itself towards a little bit slower, muted stock market growth environment. if you're a retiree or someone that's more conservative, higher rates aren't terrible for you, because now in fixed income, private credit, a lot of the alternative strategies out there that are going to be more yield bearing and or interest rate sensitive, you can take a lot less risk and still get a very, very nice yield. You know, I joke with people, I started in this industry 10 years ago, and, you know, most of my career up until 2022, interest rates have been sub 2%. So bonds were really just a placeholder in a portfolio to try to drive diversification. You weren't making anything, and you were net negative when you actually compared it to inflation. Now, if you want to go get 6-7%, you could theoretically do that completely in bonds with no equity exposure. That was not the case 3 years ago.
Right.
So I guess it depends on which stage of life you're in. High rates, again, probably aren't going to necessitate a huge run up in the equities market, but it's good for fixed income.
Oh, absolutely. Yeah. And for most of our clients, to me, it's a plus, because like you said, they don't have to take a ton of risk. I think it's causing some problems, maybe some unintended consequences, maybe in the housing market at this point, because those people who have a 3.5% mortgage or even less aren't as willing to sell. So it's restricting inventory from that standpoint. It's also limiting the refinancing that would often happen for people to do home improvement projects or other things like that. But for most of the people that we're working with, I think the interest rate environment where it is a strong plus, because now I don't have to be 70-30 to get the kinds of returns that I would really like to see for my clients. I can, 60-40, 50-50, it's a much better mix, and people are a lot more comfortable with that. So, Daniel, thank you for joining us today. We're going to have another episode here in a couple of weeks. We're going to talk about some of the things that might happen to save Social Security, and that's because it's an election year. That's going to be a very interesting topic to dive into. If you happen to like what you saw today, hit that like button. You can also subscribe. And if you're new to our channel, be sure to check out some of those past videos. We'd love for you to see what we have to talk about and the content that we create that will hopefully help you make better financial decisions as we go. You can find us on the web, cfswv.com. Thanks for watching. Have a great week.